What if we agreed on an energy supply agreement from Canada to the US where we could supply you the energy that you guys need, and all you have to do on the energy statements when you issue them to your customers is said, supplied by Canada. Pulls a Hail Mary out and signs some type of large bilateral agreement where we know they need something and we have something to give them, and everything else is just noise. Anchoring around one thing. Not gonna happen, I know, but we can all dream, can't we?
We can all dream, but when the United States is the #1 energy exporter in the world, now, we kind of lost some of our leverage. Now, what they are doing, which is interesting, is they could take our energy at a massive discount and sell it to the world, which is what they've been doing and picking up, fantastic margin. But Jesus, if that's what we're going to do, why wouldn't we be doing that ourselves?
Hey everyone, before we dive into today's Tank Talk, a quick word from our sponsor, Fasken. If you're an early stage founder navigating the legal side of startups, chances are you'll need someone like Will Shaw in your corner. Will is a partner at Fasken, and he is here to help us break down some of the common startup legal questions we get all the time. Will, thanks for joining us in the Tank today.
Thanks for having me, Matt.
Will, a lot of early stage founders that we deal with at Ripple, and obviously you deal with on a daily basis, are debating so many different things when it comes to working with investors and partners. The first thing we always ask is, should I raise a safe note or go after a priced round? So first off, what's your perspective on this, and what are the key differences a lot of founders should know about the two?
Yeah, safes are definitely faster, but they kick the conversation down the road on a few important things. Like, for example, a safe will defer setting a valuation, which makes things simple up front, but it can lead to unexpected dilution down the road if you're not managing your cap table. A price round is setting the valuation now, so everybody knows what they're going to own in the company, but it's also giving away a little bit more in the sense of rights. So a founder really needs to watch how much their dilution they're taking on, and also think about what rights they're giving away and what the timing is for crystallizing all of those things.
Right. And there's a lot of these in-between things that people also try to jam into safe notes because they are a little bit faster, but they want a little bit more protection, which we call side letters. So we hear about them a lot, Will, especially in more competitive rounds. What are some of the factors that founders should think about and look out for when an investor asks for a side letter?
Side letters can be useful, especially when the safe is a standard form. And exactly to your point, Matt, you're trying to get other rights in there. So they can give specific rights to special investors, like pro rata rights or extra information or board observer seats that aren't in the main deal. But founders should make sure they're not creating long-term risks or burden or giving one investor an unfair advantage that might scare off future investors.
Yeah, I know. We definitely obviously like having side letters as well, being an institutional investor where safe notes may be a faster path, but there are certain things that investors need to have in protection when they're not doing a price round. We have worked together on many transactions with you and your team, Will. You guys have been fantastic partners of ours, but a lot of things that happen at the beginning of a company's journey kind of end up biting them in the butt on the other side when they either exit or sell the company. Many think about acqui-hires or M&A transactions, and we all face it, not every company is going to go public. They often get acquired early and go through these acqui-hire scenarios. What are some of the things that founders should think about from a legal standpoint, if they're going forward with an acqui-hire or some type of M&A transaction?
Just start early. Keep track of your documents as you're going through things. Make sure they're in a data room. Make sure your IP is properly assigned. You make sure your contracts are clean. There are a lot of things that are simple to do at the time, but are really difficult to fix later on. And an acquirer is going to dig into everything, especially IP, the team agreements. If those aren't buttoned up, you're going to lose a lot of leverage and you may end up killing the deal.
Yeah, these are awesome insights, Will. Thank you so much to you and the Fasken team for supporting Tank Talks. All right, now let's get into today's episode. All right, John, welcome back to the Tank here. We're recording this on Monday, October 6th. Mark Carney is on his private jet heading down to D.C. for round 2 with Trump starting tomorrow, October 7th. And I don't know, the vibes are trying to play a little bit of damage control maybe around tariffs. seeing what's happening on the other side of the border with all the breakthroughs that Trump is making on his own policies. But what do you think will come out of this, as obviously pressure is mounting on Carney to deal something on, steel, aluminum, autos, USMCA, softwood lumber, everything else on NATO spending? There's a lot of things to check off on the list. But bottom line is, it doesn't feel like Trump has any incentive to really change course. He's totally in power here and he doesn't have to blink.
Yeah.
So what do you think is going to come out of these conversations as Carney tries to play offense and defense at the same time?
Yeah. I don't know what the precise topics will be, but I don't expect him to be coming back to Canada with anything. But I'm glad that he's trying to build a relationship. Part of the criticism that he had is his very first meeting in power was in the UK, if I recall, and not the United States. Trump takes these as spitefully. So hopefully he can build a relationship, because relationship matters to Trump. And I got to believe that Carney is gearing up for the November 4th budget. And remember that a lot of those had revenue assumptions on tariffs, et cetera, that wasn't there. And I suspect that the picture is going to be pretty gloomy, particularly from a deficit perspective. So he's got to come back to the Canadian people saying, hey, I've had another productive meeting with Trump. Still lots of things going on, Kuzma coming down the road, but I think it's trying to give some assurance that, all hell is not going to break loose in Canada.
Well, we've got the fall budget hopefully coming out.
Yeah.
And we don't know what that's going to say. I heard rumors on a big cut, obviously on spending in areas that maybe some people are not going to be happy about. We've got, Canada Post losing $10 million a day. That's looking to be backstopped by the government. What if this visit flops though, for Carney, and it doesn't show any kind of force for his hand in playing, into what Trump is asking for? Does he have to go fully, AWOL the other side and just slap on a bunch of retaliatory tariffs just to show that he's able to hold face against Trump? Or does he just bend the knee and try to get along peacefully with him and grow our countries alongside each other?
I think that would be a horrific strategy. The U.S. is not going away. Diversifying our trade, of course, is a great thing, but it's the biggest market in the world right next to us. And again, you're dealing with someone who takes everything emotionally. I think building up the relationship, and this is why, I was really frustrated with the elbows up nonsense. I loved the Buy Canada stuff and all the sovereignty stuff. But the implication of the big FU and we're the tough guys and that, I think that that whole feeling is not there. Even the folks that were the biggest elbows up boosters, in my networks are all quietly, calming it down and realizing, look, that's not how you influence the United States. I am optimistic that, the saner heads will prevail. But it's not going to be a better situation than we had with the pre-existing Kuzma. I expected from day one that we were going to move on average from 0 tariffs to about 10%. I'm worried if it's closer to 15. It's a disaster if it was closer to 25. So I'm still hopeful on the average of 10. But I think people have to recognize it was never going to be 0. And the fact that people voted for Carney on that expectation, well, there's a difference between elections and actually operating the country.
What if he pulls a Hail Mary and he shows up and he says, okay, you guys are signing all these massive, energy contracts with building the next future of AI, what if we agreed on an energy supply agreement from Canada to the US where we could supply you the energy that you guys need? And all you have to do on the energy statements when you issue them to your customers is said supplied by Canada. Pulls a Hail Mary out and signs some type of large bilateral agreement where we know they need something and we have something to give them, and everything else is just noise. Anchoring around one thing. Not going to happen, I know, but we can all dream, can't we?
We can all dream, but when the United States is the number one energy exporter in the world, now, we kind of lost some of our leverage. Now, what they are doing, which is interesting, is they could take our energy at a massive discount and sell it to the world, which is what they've been doing and picking up, fantastic margin. But Jesus, if that's what we're going to do, why wouldn't we be doing that ourselves?
I know, but John, everyone's seeing in the news here how much energy costs are going up in states like Ohio, right? Yeah. Where all these data centers are being sucked up with all the energy here. Yeah. There is still an energy deficiency in certain areas of the country.
Yeah, and if you believe on the demand for the AI, they can't supply it. And what is interesting is, and again, I think I had shared with you the two stories of the United States versus China. They actually have eerily similar electrification needs from a wattage perspective, and yet China is massively shifting to renewable, and the United States is massively betting on carbon-based. And who has a lot of it? Canada.
I think the U.S. has built 3 nuclear facilities in the last decade or so, and China's built 60 in the last, or has building 60 in the last year. It's quite astronomical, the difference here. But let's double click on that article that you also talked about, John, which was the Thomas Tung deep dive, which was a big reminder of what the telecom carnage that you've talked about before on this podcast was about, and how NVIDIA's vendor financing playbook is looking eerily similar to Lucent's pre-bust fever dream. For some of our younger listeners, maybe why don't you explain what Lucent did during those times and how this relates back to NVIDIA's thesis around basically providing financing in the form of circular financing and direct bets on their customers.
Yes. So I was the advisor when I was at Deloitte to Nortel during this period. It was really on the downslope. And what had happened was Nortel's revenues on the photonic telecommunication side was going through the roof, as was Lucent. And what was happening at the time was we had these companies, we call them competitive local exchange carriers, or CLECs, that were buying up fiber like crazy. And they needed all of the telecom equipment to operate new telecom networks, but they couldn't afford it. So what was happening is they did two things. They needed the product. They didn't have the equity, and so they would be borrowing massive amounts, really through sub-debt. And then Nortel would provide vendor financing for the balance. So in essence, Nortel booked the revenues, sold the product, but the economic rights were really still practically with Nortel, because if they couldn't pay for it, Nortel's basically taking the equipment back, or the equipment's worthless. And what happened is when the bottom fell out, it unraveled really quickly. And Nortel had to restate its revenues by saying it really wasn't, I can't remember the number anymore, it really wasn't 30 billion in revenue. It was really closer to 10. What's happened in the NVIDIA case, it's a little different, but it's the same concept. When you consolidate it and really say, but where are the revenues on the ultimate users, and are they really there? In the case right now with NVIDIA's, it's the same thing, but you have to bet that ultimately there's going to be an ultimate consumer at the end of the day who's going to be paying the bills. So you still don't know, but it was eerily similar. Number two, and this is the part that scared the crap out of me. And this is when I moved from being a partner at Arthur Andersen to being a partner at Deloitte. Arthur Andersen went down because of Enron. And Enron, what it was they talk about fraud. It's really kind of bullshit. It wasn't fraud per se. It was taking advantage of accounting rules. And the accounting rules were such that this is how extreme it was. You can create an SPV, only put 3% of the equity in there, control it, have that entity borrow a ton of money, and you don't have to put the debt on your books. And it was called the variable interest accounting rules. And the problem was the auditors, i.e. Arthur Andersen, should have said, guys, it's technically correct, but you're obfuscating a balance sheet by pushing off the debt. I had no idea until Tomas's article. They're doing the same damn thing. Now, rules were clamped down somewhat, but it's the same damn thing. They're hiding the big hyperscalers that are using monstrous third-party debt, are creating SPV structures to keep it off their balance sheets. And I couldn't believe, here it is again.
Okay, so let's get into some of the details here, John, because you mentioned a lot of things just for our listeners to catch up. So NVIDIA's vendor financing strategy totals $110 billion in direct investments, plus another $15 billion in GPU-backed debt. Their obviously largest commitment is the $100 billion to OpenAI, which was announced in September this year, structured as 10 tranches of $10 billion each tied to infrastructure deployment milestones.
Correct.
Another big thing that they have to deliver on. The first $10 billion was valued at a $500 billion OpenAI valuation, and then the subsequent tranches are priced at prevailing valuations. Okay, that's on the NVIDIA OpenAI side. Beyond that, NVIDIA has done many more of these. They got a $3 billion stake in CoreWeave, a company that has spent $7.5 billion on NVIDIA GPUs, and then $3.7 billion in a bunch of other AI startups. That's through N Ventures, which is the corporate development arm. Now, comparing this to Lucent, side by side, Lucent's fiscal year 2000 inflation-adjusted vendor financing book was $15 billion. NVIDIA's in 2025 is $110 billion.
Right.
The operating cash flows are significantly different, though. Operating cash flow for Lucent, $304 million. NVIDIA, as of Q2 fiscal year 26, $15.4 billion of operating cash flow. Mm-hmm. And the revenues are also quite significant. $61 billion, whatever the number you think the true number is, for Lucent. And for NVIDIA is $165 billion. Now, the top two customers for each, 23% for Lucent, 39% for NVIDIA. So that's sort of where a lot of people are getting the comparisons between the two.
Right.
Now, there's also the GPU-backed debt. So basically, the GPUs that NVIDIA is selling are held as collateral against the financings that is provided by Blue Owl, Blackstone, whoever else it is, to these scalar builders. But the SPV structure is what I want to explain for people. So that is a special purpose vehicle. We all know that from the industry. And these are being used as individual vehicles to finance the AI data center construction. So you've got hyperscalers like Meta partnering with private equity firms like Apollo, contributing the capital. And you and I both know, John, like when you got to go to Apollo as Meta to get financing for a data center, that's kind of crazy to me because like, where's JP Morgan? Where are all the tier one lenders here, right?
Yep. Yep.
And those come with pretty strenuous
absolutely
terms, right? They're not the easiest ones to get breaks on when you're negotiating. So the equity creation structure is, you don't roll this on your balance sheet, okay? You've got an entity creation of a hyperscaler and a PE firm, okay? There's a capital structure, typically 10 to 30% equity, 70 to 90% debt from the private credit markets, i.e. Apollo or Blue Owl or something. There's a lease agreement. So the SPV leases capacity back to the hyperscaler. And then the balance sheet treatment, the SPV doesn't appear on hyperscaler's balance sheet.
Correct.
Okay. Now you carry forward. Where is the risk here?
So the risk is that and what I don't know, by the way, is who has the legal obligation of the debt. So let's just say, and this is what happened in Lucent's and Nortel's case, the market was in an overcapacity situation. So there weren't customers, real customers, paying for the usage of the telecom. So the equivalent will be, is there real customers that are ultimately buying the AI services, ultimately, and embedding in their business? If the answer is no, how does that debt get serviced? and who has the guarantee of the debt. So the question, that's going to be the question. I haven't gone through in there. In the case of Enron ultimately had the guarantee of the debt. So when the shit went down, the debt was the obligation of Enron. Who's the obligor here? And if it's Meta, you as a shareholder of Meta don't realize that there is massive debt obligations for Meta if the market turns south. And that's the opaque nature. I don't know enough because I don't know what Meta has or has not disclosed, but that was, giving me PTSD of what happened to me 25 years ago.
Yeah. So the data centers are now representing 10 to 22% of major REIT portfolios, up from near 0 2 years ago. And there's also a very thin equity layer component, 10 to 30%, means that if a data center utilization falls short of projections, or the GPUs deprecate faster than projected, which we said they are deprecating.
3 years.
The resale market is 3 years. They sell for 20 to 30 cents on the dollar. Equity holders face losses before debt holders experience any impairment. So this is pretty interesting. You got to start watching this. You got to see, where are their defaults in the debt? What are the GPU utilization rates? Are they stockpiling these things for later? What kind of customers are being added? And then obviously vendor consolidation. And so this dovetails nicely into the IPO that just went out that you also wrote about, which is it's pretty crazy how this all ties together.
Yeah,
okay.
Yeah, that was
so
insane.
It is pretty insane. So for our listeners, there was a barely 9-month-old Fermi America, which was co-founded by ex-Energy Secretary Rick Perry, just IPO'd as a revenue-less REIT, valued at $13.9 billion to build the mother of all data center campuses in Amarillo, Texas. I could only picture Rick Perry wearing his Texas boots and his Texas star championing this thing when the shovels hit the ground. But they're talking about a 5,236 acre land lease from Texas for a 1.1 gigawatt of natural gas turbine for power, basically the same amount of power, 8 million homes worth of AI thirst without a single binding customer contract. Can you explain, what's going on here? We've got things like the Yellowstone Club for hyperscalers being dropped in articles, premium land, questions around supply of energy, water access, things like that. This thing went public, John.
It went public. There's no revenues. There's no assets. There is a lease agreement with a Texas-based university in Amarillo to build this, and there is a soft commitment for an energy provider. I don't even know if the energy connections are there, et cetera. But there's no there. And this went public. It hit right after going public, it almost doubled in price from.
It got it to $36.99 is its ultimate high.
$39, it says here.
39 or so, and it's trading now at $26.80.
So the market is starting to go, okay, this is getting ridiculous. So it was valued at $13 billion. It went up to about 26 or some number that it's now getting back down already in 5 days, back to that $13 billion. But when you start to see things like this, where there's no there, it's still worth $13 billion and you got nothing. You start to really worry. It's crap like this is what gets people starting to realize, hey, even that good stuff is a crap in there as well. So that was a very problematic situation.
They're on road shows. They've got to secure like $2.5 billion of debt. The CEO, Toby Neugebauer, is worth his stake is worth 2 billion, 4 billion at the IPO, and Perry's is worth 500 million. It's crazy to see a REIT basically without any real estate in it.
So two other things was really bizarre. So I happened to read the thing. So I don't know who this founder is, but apparently on this previous startup, there was some really shady business, and the information had details around that, but it's structured in a REIT. So a REIT is a real estate investment trust. You must distribute a minimum amount of your distributable cash flow. Can't remember if it's 80 or 85% must be distributed. I almost laughed at this. Where the hell is the cash flow going to be on this damn thing for years and years. But the audacity of being in a REIT vehicle where you're going to need cash flow to continue to replenish the GPUs, I thought it was utter nonsense, but the public bought into it.
Hey, the public's buying into a lot of these stories. Today, there's the AMD OpenAI partnership, multi-year pact to deploy a whopping 6 gigawatts of AMD GPUs for OpenAI's next generation AI infrastructure. I mean, that's enough to power a small city. This is incredible amounts of energy contracts that are being signed without any of the energy to supply it. And the contract that they signed is quite interesting. Basically, it starts with a 1 gigawatt AMD Instinct MI450 series GPU chips rolling out in the second half of 26, scaling up to across future generations of chips that AMD is going to supply. And for the partnership agreement to sweeten the pot and align incentives, AMD is just casually tossing OpenAI a warrant for up to 160 million shares. Basically 10% of the company is struck at a penny if they choose and they hit certain targets as well. So this is a win-win, as Lisa Shu calls it, for massive AI buildouts. But Sam Altman most recently valued at $500 million, right? Bigger than a private company, bigger than AMD, signing these contracts. Right? 500 million, signing these contracts. It's quite interesting as this arm race kind of gets everybody inside the tent together, swapping equity, swapping warrants, swapping energy supply agreements. It's all coming together quite nicely, isn't it, John?
Well, the key word is going to be here, following the money. And it's becoming way more brutal and trying to catch the circles on here. So it's funny. And you saw, Matt, Jeff Bezos very surprisingly waded into this whole debate.
He did in Italian Tech Week.
Yes, sporting a new look for him, but
popped off the yacht, jumped into a Tech Week panel, and jumped back on,
and was deeply concerned on. Again, he was focused more on the investment side of an AI bubble, not the ultimate, generator of value over the long term, but. I was surprised that he waded in, just given the amount of criticism that he had faced early on with Amazon on whether that was going to bust.
He called it the AI sort of situation we're sitting in now as an industrial bubble rather than a financial bubble, right? Where there's obviously a huge amount of investments going into a certain asset class, which we saw obviously in the global financial crisis right now. And obviously the most famous of all tech bubbles, the dot-com crisis, where the values of internet stocks were not justified for any of the opportunities that they had in front of them because none of them came to fruition. And there's a disconnection between the fundamentals. But what he was saying in the industrial bubble is more like there is a huge amount of demand to get access to this industry of AI, let's say. And the technology that people are building is real. The value that will come out of it is real. But there's a dislocation between how much money they are absorbing versus the value they create in the short term. Right. But in the long term, there will be value and there'll be great products for people to benefit
this
from.
Is exactly.
But there's going to be a lot of pain in the short term for people who are pushing money into these assets that don't necessarily match the time frame of when that capital needs to come back to pay the underlying investors.
That's my view.
Yeah. Well, it's interesting. We'll see how that plays out, John. But until next time, thanks again for joining us in the tank.
All right. Thanks, Matt.